Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Toronto, Ontario, Canada. And I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. Today, I am going to serve as a news anchor because there are so much to cover from the federal budget. Some of them are really related to the real estate investor world, and some of them are not so related to the real estate investing world. Now, before I get started, make sure that you give us a thumbs up if you like our video, if you want to share it with your friends by all means, and if you have questions or any comments or any compliments on my work, feel free to leave it in the bottom below. I welcome all compliments too. Now with that, let's get started. Although today's topic is federal budget, but coincidentally, just before the budget was announced, there were two news that came out that affect real estate investor. The first one was about the Underused Housing Tax Act that everyone was going all crazy around, and I was told that only one mainstream media had covered it, but it is definitely rocking the entire accounting firm's world. Now this Underused Housing Tax Act, we have a different video that you can watch in detail about, is originally and will always have a filing deadline April 30th. If April 30th falls on a weekend, then it will be the following day. So in this particular year, the filing deadline for UHT will be May 1st, 2023. Now, CRA just announced the night before the federal budget was announced that this UHT form will carry no penalties or interest for any filing that is submitted before November 1st, 2023. So essentially, the filing deadline is still April 30th or May 1st to be accurate for 2023. That $10,000 and $5,000 penalty will not be imposed. Now, there is no clear guidance from CRA whether this type of penalty or interest will affect next year's filing. If you are filing your tax return late for 1 year, even though there is no penalty, and then next year you also file your income tax return late the following year, 2 years in a row, the penalty on the second year will be increased to 10% instead of the original 5%. So it really goes back to whether you're subject to any interest or penalty or if they are going to change it. Doesn't sound like it, but there is no clear guidance from CRA as to whether it's going to affect the next year, the following year's filing at all if you were to file late. So in my accounting firm, in my practice, when we work with our client, we always try to report everything on time and file by April 30th. Now, the second news is also good news. They had made an announcement and adjustments to the foreign buyer ban on purchasing residential properties. As a matter of fact, I have actually a couple of employees who are here on work permit. They are not quite permanent resident. They are waiting to be invited to apply to become permanent residents. These people are working here and they're interested in buying a property. And one of my newer staff members, she is also in the process of trying to look for a house, take advantage of the slower real estate market right now to purchase her first home, and she would not be allowed to purchase any property under the new foreign buyer ban. CMHC came out to amend that and essentially allowing people who are here for work permit to be able to purchase their home. And they may still be subject to the Ontario 25% foreign buyer tax though. So one thing that my staff member is working on is to wait for the invitation for the government to invite them to apply to become a permanent resident. So they have certainty in terms of when they would be able to become a permanent resident, and then they would be able to purchase their first home. So those are the two news, totally unrelated to the budget. Now we can go back to the budget. Now, so some good news coming from the budget. There is no increase in terms of personal tax rate at all. I think it comes as not as a surprise at all because it's getting harder and harder for regular day-to-day Canadians to live with the rising grocery bill, let alone paying more tax and paying more contribution to the government. So that's a good thing. Now, the second thing is that in the past, historically, for the last probably 5 to 6 years, I've heard from all of my other accounting firm colleague, telling me that there was always this chance to increase the inclusion rate, capital gain inclusion rate from 50% to a higher rate. So currently, capital gain, if a transaction, the sale, the profit that you make from a transaction is considered capital gain, only 50% of the profit that you make would be taxable. So there was always these rumors in the past 5 years that talked about how there is a way to increase, the government plan to increase that inclusion rate, the 50%, to something more. So instead of 50% that would become taxable, added to your taxable income, it could be 75%. At one point in the Canadian history, Canadian taxpayer would have to pay 75%. Tax on 75% of the capital gain that they made. Now, that also didn't come through, and that is kind of expected, I would say, but it is worthwhile mentioning because the market has come down and there is no immediate need. It would be even worse from the government's perspective to increase the inclusion rate. It's already hard enough to do anything in Canada, let alone increasing an investment and paying even more tax. Now, let's look at the big picture. Budget deficit, this year's budget has a budget deficit. It has been a deficit for a number of years, many, many years to be honest. This year's budget deficit is about $40 billion. Essentially, we have revenue, we have expenses, and we have a loss of about $40 billion. So as a country, the federal government has spent $40 billion more than they've earned. To me, it's always interesting to see how the government spend as in comparison to how we personally or how we as a family spend. Because imagine that as a family, you're spending, let's just pick some manageable number, not $40 billion. Let's say you overspend, you make about $100,000 and you spend $140,000 in the year. So you are now $40,000 into deficit. Now, what would you do? What would a regular financially responsible person would do? Well, some people would dig into their asset and try to sell asset to cover the $40,000 debt. They could also dig into their saving. Some people, on the other hand, just like our Canadian government, they would continue to borrow money. So borrowing money for us, individual or for families, to go to the bank to ask for $40,000 is a lot. The bank would check our credit report, they would look at our income, they would look at our job status, they would see if you would be able to have the ability to repay that $40,000. But in reality, with our government, they don't need to worry about that because they would just take that $40 billion, add it to the $1 trillion of debt that we have, and it's kind of buried somewhere there. And if they ever run out of money, the easiest thing for them to do is essentially turn around, issue more debt, and finance their deficit with more debt. So that's exactly what they're doing. They're just printing more money. So it doesn't sound like a very financially responsible way of spending. To them, it's better to borrow, fund the deficit using debt, and refinance our debt and pay the increase in interest expense. And the solution to our financial problem seems to be, well, let's pay for our deficit with infinite amount of debt. The picture that our government is painting is that, hey, we are the best of the G7 in terms of our debt to GDP or interest rate to GDP ratio. So we're doing okay because the other G7 countries out there are doing way worse. So we must be doing okay. The public debt is created by borrowing more money from printing, so which in turn would then fuel inflation. And the reason why we are going through these interest rate increase is because of inflation. The government is trying to tighten this inflation situation, inflationary period, by increasing interest rate. So unfortunately, my prediction is that our cycle of this printing money, quantitative easing, and quantitative tightening by increasing interest rate will be more frequent in the future. So there will be more ups and more downs and ups and downs more frequently happening because of how our government is spending. Now, that is the macro look at the federal budget. Now we can zoom in to look at how the budget is affecting everyday Canadians and specifically real estate investors. If you look at budget 2022, so last budget, it has a lot of tax measures or policies that they've implemented over the last couple of years and will continue to implement in current year and future years to control or trying to tame the investment activities in real estate market. So that includes anti-flipping rules, the Underused Housing Tax Act. There is a first-time home buyer saving account that will be coming out. And that was very exciting last year. There was also a change in assignment deals. For any of you who are interested in learning a lot more about what we just discussed, you can look at the other video that I did previously. Now, into the budget 2023, because the real estate market actually tanked, so there isn't a lot specifically mentioned for the Canadian real estate market. They did mention that they are going to lower the criminal interest rate. So for those of you who are borrowing, they're trying to lower the criminal interest rate to be imposed to be only 35% instead of 40-something%. I think it was 49%. Don't quote me on it. Now, so they're trying to do that, and it also sounds like the federal government will be publishing a guideline to allow the Canadians with mortgages difficulties, with exceptional circumstances, not able to afford their mortgages, to have some flexibility. So, for example, they would allow for adjustments to their payment schedules, because for mortgages, you are committed to pay either on a weekly basis, monthly basis, or semi-monthly basis. So they are going to allow some adjustments to the payment schedule. They would also allow for a lump sum payment, and they would also, in certain circumstances, apparently, they would also allow the mortgage borrower to have a temporary amortization extension to beyond 25 years. So I don't know how that policy is going to come out and affect real estate investor. I hope this guideline would come out and it will be not just a guideline, it is something that the bank will follow, and so then the Canadian real estate investors as well as homeowners will be able to benefit from the lower monthly payment. The government also committed to invest an additional $4 billion to co-develop a housing strategy in urban area and suburban area. And the government promised to consult on changes required to remove any red tape for home buyers seeking alternative financing solution to get into home ownership. Now, these are all the highlights for Canadian real estate investors. Not a lot compared to last year, because last year we have flipping and all these other rules, and that is the tiny little bit for real estate investors as well as homeowners. Now, on to a bunch of other policies that get a lot of attention, but relatively, to me, is not a lot of information out there that could be relevant to everybody. Now, first and foremost, that gets most attention is the grocery rebate. And it is interesting because the government is again giving away money, and the media seems to put a lot of attention on this grocery rebate. And this grocery rebate will be distributed as part of the GST credit. And if you qualify for the GST credit, you will also qualify for this grocery credit. And it has a phase out just like the GST tax credit. Everyone who qualifies for it, for any family income that's over $40,000, you will probably not get the full amount. The maximum amount an adult would get is about $153. If you have a child, and there is an $81 per child you'll get, and there is an $81 for single supplement. So not a lot, but the media seems to put a lot of attention to it. Now, there's also some changes to the RESP plan, some changes to the RDSP plan. So RESP for parents out there who are setting up an RESP, registered education saving plans for their kids. You will be able to contribute to the RESP plan using your after-tax money. So contribution is not deductible, not like RSP. So you contribute to it, and the government is going to give you a supplement to match certain amounts, and then it can grow on a tax-free basis, and the income would then be would be on a tax-free deferral basis until the child goes to university or any qualified institution and withdraw from the plan. And there is a cap on the amounts that you could withdraw from the plan. It was $5,000 for full-time kids in a 12-month period, and now it's increased to $8,000 if the child goes to qualified institution full-time. The small changes to RDSP, Registered Disability Saving Plan. If you have kids, if you have someone in your life that qualify for the disability tax credit on their tax return, you or that relative's parents or partner or their brother or their partners and parents would be eligible to set up something called registered disability saving plans for the disabled person. And the maximum contribution to the plan is usually $200,000. And the contribution, again, is non-tax deductible, but the money within the plan would be grown on a tax-free basis until the withdrawal year, and then it will be taxed in the hand of the beneficiary, kind of like RESP. Now, the next thing is the Canadian Dental Care Plan. September 2022, so last fall, the government of Canada already came out to create this Canada Dental Benefit Plan for eligible parents and kids. Essentially, tax-free payments for up to $1,300 over 2 years for a child to cover dental care expenses, and many people have taken advantage of using this benefit already. And in budget 2023, they decided to expand this whole dental care plan to beyond just children. They also wanted to help low-income family members and adults to enjoy this particular benefit. So this whole expansion of the plan will cost about $4.4 billion on an ongoing basis. But the first few years is going to cost $13 billion. It's a lot of $1 billion flying around. So that's Canadian Dental Care Plan. There is a new deduction available for Tradesperson. So if you are a Tradesperson and you qualify, you are required to use tools and purchase your tools, you will be able to get extra deduction as well. On top of the $500, now it's increased to $1,000. CLA is also trying to, the government is also trying to increase their revenue. They are changing their alternate minimum tax regime. Now, so what is alternate minimum tax, or AMT, to begin with? Well, if you don't already know, when you file your personal income tax every year, you're evaluated using two different formulas. The first one, which is applicable to majority of us, is the progressive tax system. If you don't know what the progressive tax system works, how it works, you can watch my other video about our income tax system together with the tax credit. Now, alternate minimum tax system is a different system, different from the progressive tax system. So it is a different formula. Your income tax deductions and tax credits are being plugged into a completely different formula from the progressive tax system to come up with a different tax payable balance. And CLA is then will use that formula and use that tax payable and compare the tax payable that you would otherwise need to pay under the traditional progressive tax system. And if the amount happened to be the tax payable that they are expecting under the alternate AMT tax system is higher than the traditional one, then you will need to pay the additional tax liability. Now, traditionally, this tax would catch people who have sold shares of qualified small business tax and utilize their lifetime capital gain tax exemption, or made a large amount of donations and have a huge donation tax credit that trigger them and allow for not paying any tax. And traditionally, it's used to target people who have large income but very little tax payable. And so now the government is proposing to change the formula of how they increase the AMT to tax those ultra wealthy individuals and eliminate those people who are truly middle class and should not have been caught under the AMT system. So it wouldn't be relevant to the majority of the Canadians out there, but for those who are affected, you could pay as much as double of what you would originally get taxed at. Sad, but they're also narrowing the definition that the AMT would apply. Now, next one is student benefits. So CRA is also proposing to increase the Canada Student Grant. When I was in school, 10 years, more than 10 years ago. I don't really want to name how many years ago when I was in school, but I also took advantage of the Canada Student Grants. When Budget 2023 is proposing to increase the student grants by 40%, raising the interest-free Canada student loan limit from $210 to over $300 per study week, and waiving the credit check requirement for adult students. An interesting one here, small business credit card fees. We see that a lot of the fees are being added to event tickets. There's credit card fees being charged, and as a matter of fact, for those of you who don't know, as a small business owner, every time our customer use the credit card, we are being charged as much as 3.6% on every transaction. Well, you may say, well, 3.6% is nothing. Well, the reality is 3.6% is a lot when you add up. So now they're proposing, the government recognize that there are these extra fees being charged, and they're recognizing that ultimately is the credit card processing company that are increasing their fees, and that causes small business owners to pass on these additional charges to the ultimate consumers. Have a commitment with Visa and MasterCard to lower their fees as much as 27%. Well, hopefully I'm going to see some bank charges saving over the next year or so. Now the next change is the GAAR, General Anti-Avoidance Rule. I don't know if anyone is familiar with GAAR. Essentially, if CRA can't argue with you, can't win the fight with you based on the Income Tax Act or Excise Tax Act, whatever act that they're basing it on, CRA would try to imply something called General Anti-Avoidance Rule, GAAR. Essentially, basically, it is a rule that would prohibit you to implement a tax plan saving strategy if your sole intention is to save tax. What they have changed is essentially they further clarify in writing how GAAR would apply to tax planning scheme, and of course trying to make their job. Now we've covered almost all type of measures in the federal budget that's being proposed. It is interesting to see how everything is going to come together over the next little while. Any changes, any major changes, we are definitely on top of it, and we will share that all with you. Now, until next time, happy Canadian real estate investing. If you like our video, don't forget to give us a thumbs up. Have a great day.